One of the things Vivek was saying was, okay, so we need to promise that we're going to guarantee people's investments or their deposits at their banks more than $250,000. So the FDIC can step in now and say, God, terrible thing that happened at a Silicon Valley bank, but don't worry, we won't let that happen to you if you're at a small to mid-sized regional bank. We're gonna up the insurance that everybody has, but bye to Silicon Valley Bank, right? Like his point was, why are we saving them? We can restore consumer confidence in banks, including small ones and mid ones, just by offering a new guarantee. We do not have to save this bank from the consequences of its bad decision making.
Well, you would take down then hundreds of startups that had their cash parked there. And at a time when we're...
But why do we care? But why do we care, Steve? Because the argument is, and I'm not taking a position on it, but the argument is these are smart investors. They made the decision. They put their money where they put it. And the other argument was most of these, as you point out, are startups backed by VC firms. And so if the VC firms wanted to save these companies, they could.
But if the money is parked at a bank that is going under, that becomes problematical. We're at a time when we want more startups, not fewer. And in terms of the bank itself, the banking system, as you know, is closely interrelated. And so making sure this bank failure did not ricochet to the rest of the banking system is a smart decision. Again, the good thing they did was they wiped out the shareholders, wiped out the unsecured debtors, security holders, and management is going to get it. I guarantee you on the management, unlike what happened after 2008, this management is going to go over the skewers, and they're not going to be allowed to keep any of the money they've taken out in recent weeks.
Right.
So in terms of the bank itself, if you want to, the VCs had their money parked in the bank. So if the bank is, if you can't access that cash, you've got a lot of startups that are going to go down at a time when we want more startups. We're in a technological race with China. So I think in terms of the bank itself, you can you could have actually, in terms of saving the bank, again, there are a lot of assets there that other banks would have been gladly willing to buy. And why the FDIC?
Right, it was mishandled. Well, wait, but you want to blame the FDIC. You want to blame the FDIC. We wouldn't have had the problem. But wait. It works better if it's back and forth. So you want to blame the FDIC, but what about the CEO of the bank? Because there's a report today at CNN citing. Well, let me tee it up, Steve. Let me tee it up. That some of the employees are very angry with this CEO. He's now been removed, Greg Becker, for making it public in the first place that they were facing a $2.25 billion shortfall, that they needed to raise that kind of money. Why would he say it publicly, which in part caused the run on the bank, rather than just raising it privately, rather than going to some other bank privately and saying, do you want to save Silicon Valley Bank with this money?
Well, that's right. And it's, as I mentioned earlier, it's both sides. Management made huge mistakes and not hedging, ensuring if they decide to go out long and try for yield. And in terms of the rescue last week, there are plenty of people willing to buy that bank. But this guy, Becker and his team, chose to act like deer in the headlights. So they bear a large responsibility. Again, the bank has a lot of great assets, and there have been a lot of people out there who know how to deal with these things who have been glad to buy into them. Just like Warren Buffett saved General Electric and some other companies in 2008, you paid a price for it, but you got rescued. And the amount of money they needed to make up their equity shortfall was peanuts compared to what the losses that ended up happening. So bank management deserves a lot of the blame. There was no reason why they couldn't have just quietly said to the regulators and to VCs and to other banks, we got a short-term problem. It's going to cost X billion. And there have been plenty of people at the right price who have been quite willing to step in and buy and do what it took to prevent a massive failure. And this is where, though, it gets to what the FDIC did. Why didn't they try to facilitate that instead of dragging their feet? So there's a lot of blame to go around. And ultimately, getting beyond the particulars of this disaster is why we're the central banks of the world and our Treasury Department for years having a policy of no interest rates. And when you distort the market, we all know what happens when you have rent control. Larry Summers once said, rather indelicately, there are two ways to destroy a city. One is to bomb it, and the other is to put in rent control. And what the central banks did after 2008 was they put in the equivalent of rent control and interest rates, sent them to levels they've never seen before in human history. That's had two consequences, which is why I'm worried about the future short term. A lot of countries went heavily in debt because it was free money for the politicians to spend. Japan, for example, has a national debt twice that proportionally as the United States. A lot of developing countries went binging. A lot of companies that could borrowed. Even solvent, great companies like Apple, which has a huge cash flow, ended up borrowing over 100 billion. Why? Because the money was virtually free and any interest was tax deductible. So they used it to pay dividends, buying stock and all that kind of stuff. And so the Fed and the other banks distorted the market. So it's a critical reason why we've had punk growth rates.
Well,
under Trump,
I get it.
to get some growth rates. So
let me jump in, Steve. Let me jump in. I get it. I got your point. I want to move the discussion forward because we only have you for a block.
Okay.
So the one of the reasons that the markets actually took an upturn for a bit yesterday was people were speculating that the Feds would not issue another rate hike now on the interest rates because of what was happening at Silicon Valley Bank. The reports were yesterday we lost $100 billion wiped off of U.S. banks' value in what was being described as a bloodbath on Wall Street. But there was some hopeful speculation that all of this would stop the Fed from raising interest rates again. However, today we see inflation is basically holding steady. We're at 6% again. It's just a tick down barely from last month. And so that's what the Fed has been raising the rates to try to stop. And so now there's speculation maybe it won't stop him. Maybe this crisis will continue because the interest rates don't seem to be budging much. The inflation does not seem to be budging much.
The Federal Reserve, the big problem there, and that's shared by most economists and all other central bankers, is they believe the way you fight inflation is by depressing an economy, making people poor, trying to increase unemployment. That's not the way you fight inflation. The definition of inflation is when you lower the value of your dollar, in this case the dollar, lower the value of your currency, usually by creating too much of it. So you don't, and back in the 70s and early 80s, we went through repeated recessions to fight inflation. What finally conquered the inflation was not a bad recession, was when after the 81, 82 recession, the Federal Reserve started to stabilize the value of the dollar relatively instead of trashing it. And that we had a government that was cutting taxes, doing deregulation, and allowing the economy to boom. This government is doing the opposite. They want to raise taxes. They're piling on regulations, doing everything they can to throw sand into the gears of the economy, even though they say they want it to grow. They're doing everything possible to stop it. And you have a Federal Reserve that totally misunderstands inflation. Inflation is not, there's something in economics called the Phillips curve. It's not a baseball pitch. It's a theory that if you want lower inflation, you have to have higher unemployment. If you want lower unemployment, you have to have higher inflation. Experience shows that's absolute nonsense. But at the Federal Reserve, it's holy writ. So they may back off on trashing the economy this round. But if they go back at it, we're going to have a troubled economy. I don't know whether the economic theologians will ever call it a recession, but people are in for hard times. And because a lot of companies and some banks got addicted to low interest rates because they seem to be around forever. You saw in Britain, their pension funds had a disaster in the fall because they were trying to reach for yield. And when rates went up, oopsie daisy, the government in effect had to bail them out. And so what you're going to see here, a lot of companies that dependent on free money are going to get in trouble in the next few months. So the Federal Reserve does not know how to fight inflation.
This is the beginning of something, not the end. Okay, let me switch gears and tell you that we just got this breaking news in. The collapse of Silicon Valley Bank is now under investigation by the Justice Department. They are in the early stages of investigating it. Fox News confirming the Wall Street Journal first reported this morning, saying the SEC is also investigating. In particular, the government probes will look into stock sales that the bank's financial officers made days before the bank collapsed. We were told by some reporting that those were automated, pre-scheduled sales of stock by the executives, but they made millions off of them. So the Justice Department will look into whether there was fraud, whether there was there were other misdeeds. But that leads me to another question I have, which is, much in the same way we had Arthur Andersen collapse after Enron went down, right? Because it was the accounting firm for Enron and had given it all these clean bills of health. And now we know that that was not true. KPMG, as it turns out, another big accounting firm, 14 days before it collapsed, gave the Silicon Valley Bank a clean bill of health. They signed off on the audit, and they're saying, oh, well, we weren't looking at current day. You know, the audit looks back on the previous 2022 year, but that doesn't save it. It's also supposed to be looking at whether there was anything in between the close of that year and the current issuance of the audit report that would change the clean bill of health that it's offering. That it's not going to be able to save itself by saying, oh, we were only looking backward and we didn't, look up to present day. So how can our accounting firms get it so wrong? I would be remiss if I didn't mention Forbes. Forbes also, magazine, not you, put Silicon Valley Bank on its annual list of America's best banks just weeks before regulators seized control. You are not KPMG, but why wasn't this seen? By KPMG, by you guys, by more people who are supposed to raise the alarms on things like this.
On our side, KPG can explain themselves. But on our side, we took numbers, the latest numbers, which was the end of the third quarter, and used 9 metrics. And there was nothing in those publicly disclosed metrics that had the huge mismatch between liabilities and assets. That's something that should have been known internally and certainly by the auditors. But the public information was not there, which is why stock analysts didn't see that kind of problem. But the thing is, yes, have those investigations of management and the accountants, but also don't let the FDIC and the Federal Reserve off the hook. The FDIC is in the business of making sure that when a big bank gets in trouble, that you contain the trouble, that you sell the assets. Usually there are assets there that can be sold. And with the Silicon Valley Bank, there are plenty of assets. And why wasn't that done?
Sherry from Omaha, Nebraska has this to say about Genucel. Quote, I have sensitive skin and I'm careful about all products. Then my husband bought me Genucel's immediate effects product and the Genucel Deep Firming Serum. Felt it working immediately. Eyes look amazing, face feels smooth, and it diminished the appearance of wrinkles. So impressed, and thanks to Genucel and my husband, I now take Genucel everywhere. End quote. It's not just Sherry. Genucel has sold over 1 million products to women and men across this great country. Say goodbye to fine lines, wrinkles, and even those annoying under-eye bags and puffiness from years of endless Zoom calls. And look 5, 10, even 15 years younger, just in time for warmer weather. Best of all, guaranteed results in as little as 12 hours or your money back. Go to Genucel.com to see for yourself with 70% off their most popular package. That's all their best stuff, including the classic under-eye bags and puffiness treatment, free shipping, and luxury beauty box containing 2 free gifts with every subscription. Go to Genucel.com/MK60. That's GENUCEL.com/MK60. Hey, thanks so much for watching. If you like what you just saw, hit the subscribe button for more clips and full episodes.